Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Mangalam. Guys, hi, good morning. And I think after 2 weeks of holiday shortened weeks, this is a full one.
Yes, sir. So it's the start of a new week and the end of the streak of shortened weeks that we had gotten. And this one's a heavy week. We have a bunch of earnings reactions this morning. Then you have HUL, I remember Tata Consumer, end the week with Reliance earnings on 25th.
And you've got HCL Tech Mahindra. I think about 6-7 nifty earnings which report, and then you've got the expiry as well, and lots to track. We'll be at the mercy of Trump and tariff announcements and the negotiations.
It's a nice dress, Reema. You're looking nice.
Thank you. Green is the color?
Green is the
color.
Green
is the color.
Green is indeed the color.
I mean, I think, it's looking better. It's looking better despite, disappointments from Infosys and otherwise, generally the environment, apart from Infosys, ex-Infosys, even if you take out some of the other results which came post-market hours on Friday and over the weekend, it's not looking all that bad. So, well, let's just get to it. And of course, we'll take it from the top in terms of global, where we left off, etc. So where we left off was a very good week. So it was a very short week, but it was a punchy one. 3-day week, last one, right? Monday was shut, Friday markets were shut. And look at the change, 4.5 on the Nifty, 6.5 on the Nifty Bank, and the small and the mid-cap indices up 4.5% apiece. So this is, a very, very good way. And by the way, this is the second week that the markets have done repair, recovery in a very strong fashion. So let's take it forward. We have over the weekend data which shows the first estimate of the impact of the US trade war. This is data from an organization which contains container bookings around the world, and they track about 65% of all container which moves on seas across the world. And this is what it shows. This is April first week compared to last week of March. US imports coming into the US are down 64%. US exports are down 30%. Now, just one caveat, because the 2nd April the tariffs were coming in, and that was the pronounced date when Trump would have announced tariffs. A lot of exporters and importers would have sent in and sent out their stuff to beat that deadline. And this data most likely would be marred because of that. But even if you adjust for that, these are very large drops that we're talking about. And we'll look at this closely. Of course, this is the first week of April, and we'll get more as we go along. This week, you get the April flash PMI numbers, which I think will be also a very good first read on global impact of Trump tariffs. Consensus expectation, I looked at some numbers. They're expecting a small down, but nothing very large. But I think markets will be sensitive to this. World Bank, IMF spring meetings. This is only important, it happens every year, but this is important essentially because leaders will gather and, maybe some commentary around the impact of Trump tariffs. So that headline risk is there. G20 finance ministers and central bank governors meeting April 23rd to April 24th. Again, for the same reason. Heavy earnings, 34% of S&P 500 will report in the coming week, this week, basically. Macro markets are all steady. The 10-year $4.3 index near 100. Oil has bounced back from about 60 to 68. We are about 68 now. As of Friday's close and over the weekend as well. The one commodity which has done phenomenally well is gold. Gold is up 7% since the 8th of April, which is when the tariffs were paused. And if you look at broker after broker, everybody is basically bumped up their estimates of where they see gold by the end of the year. By the way, this is the best start. As of today, this is the best start gold has had in any year going back to the 1970s. Basically, January to April, you go back, and this is the best start to any year since the 1970s. So, super one there. Just India, and of course, the trade negotiations, I think a lot of focus will be there. So, India's trade team, led by the chief negotiator, Rajesh Agarwal, will visit the US this week. And they're going to be speaking to their American counterparts for 3 days starting the 23rd of April. Remember, this is not to hammer out a deal straight away. This is to kind of agree to the outlines of the various things that negotiations will touch upon. So this is kind of, a prelude to the actual negotiations which will happen. I mean, the timeline which has been given to us is that we'll probably get to hear something in terms of a bilateral deal. This is not the tariffs per se, which Trump has announced and has paused now, but this is a trade deal between US and India by fall of this year. That essentially has been the guidance. And of course, I mean, that FTA between India and UK, we reported source-based information that is moving towards the final stages. So with having said all of that, let me quickly put out the levels. Nifty on Thursday retested the March highs of 23,869, but we did not close above it. So that becomes the first kind of starting point. The next resistance comes in at 23,960 and then 24,551. 24,551 is a number we put out earlier as well. It's the 61.8% retracement of the full fall that we've had. Support for the Nifty, 20-hourly average, 23,460, and then the 40-hourly exponential, which is 23,225. Bank Nifty is almost back to its all-time high, which is 54,467. That's the first level to take out. But then now you got above all-time highs, you got to use extensions. And here, upside levels are 44,474 and 54,474 and then 56,631. So these are the two levels, and support for the Nifty Bank comes in at 53,095. Again, 20-hourly and the 40-hourly exponential, which is 52,369. I mean, the mood is generally quite all right. Lots of Asian markets are still shut because of the Easter weekend, but the mood generally is not all that bad at all, despite that infy miss that we had. 18 points lower is what you have on the GIFT Nifty.
Indeed, the bulls have regained control on Dalal Street. We ended higher for the second consecutive week, and we've also recouped all our tariff-related losses by closing above the March swing high. Not closing, but by moving above the March swing high, but not closing above it. But let's straight away get to the cues for the week. In terms of corporate earnings, on the IT side, you've got HCL Tech and Tech Mahindra. In terms of consumer names, it's HUL and Tata Consumer. You've got an Axis Bank and SBI Life in the financials, and Maruti in the auto pack. And globally, all eyes will be on Tesla. Tesla, remember, has down 36% YTD. And globally, Tesla and Alphabet will be on investors' radar. Back home, you've got the monthly April expiry on Thursday. And not to forget, US Vice President J.D. Vance will be visiting with his family India today. It's more of a cultural trip, but it's still the first American Vice President to visit India in 12 years. And there is that dinner with Prime Minister Modi. Wall Street on Thursday had a bit of a choppy session. The big story was United Health, which plummeted 22-23%. And that has about a 9-10% weightage on the Dow. So Dow closed down with a cut of more than 1%. US President, by the way, we're not bereft of any drama over the weekend. US President stepped up his attacks on Federal Reserve Jerome Powell. He posted on Truth Social, and that quote is up for you on your screen. Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another typical complete mess. Powell's termination cannot come fast enough. In terms of flows, the FIs bought in the cash for the third consecutive day on Thursday. They bought about 4,668 crore. Stocks to watch, well, three of them, top of mind, Infosys, HDFC Bank and ICICI Bank. Infosys ADR closed with a gain of about 2.5%, but in after-hours trade, it was up more than about 2%. And, Infosys, through FY25, kept raising their guidance. Thrice they raised it. They started the year with 1 to 3%. They kept raising it, finally made it 4.5 to 5%. But ultimately, given the way the year ended, FY25, they couldn't hold on to it. So that's the story for Infi's guidance.
That's the story for Infi's guidance. Let's see whether, you guys are talking about India doing extremely well. In the times of uncertainty, there's just gold and India, both of them doing extremely well. So if you just take a look at the way the markets are poised right now. On Thursday itself, the Indian indices did extremely well. The Nifty went back to that 23,850 mark. The Nifty Bank went within 60 points of a fresh record high. The mid-cap index at an index level was underperforming by gaining just about 0.2%, but by and large has been doing extremely well. The important part is whether this outperformance continues or not, because Nifty is now up 2,100 points from tariff level lows of 21,745 odd itself. And if you look at India versus the world, in the last 1 week, versus the last 1 month, India is the only index which has done extremely well. The last 1 month, Nifty is up around 2.15%, an outperformance of anywhere between 6 to 10% versus Nikkei, Hang Seng, Dow Jones and Nasdaq. Last 1 week itself, the Nifty was up 4.5%, as was the sensex. The Nikkei was the only major global index which was in the green. The others, all of them in the red. So India has clearly been shining, has been doing extremely well, and a large part of that has to do with our domestic-facing names. Now the problem is that the Nifty is around these congestion zones. 23,800 to 23,900 is where the Nifty's high was on Feb 5th, March 25th and April 17th as well. Can we be third time lucky? The answer to that will depend on a couple of things. One, on the way up, we have the 200-day moving average on the Nifty. Do we conquer that? And secondly, can the Nifty Bank lead this rally once again? The Nifty Bank likely to hit a fresh record high today, went within 60 points distance from a record high on Thursday. And the answer to where the Nifty Bank goes on to the result reaction that we will see from both HDFC Bank as well as ICICI Bank. From a flows standpoint, all things are pointing in the up direction. Why is that? Because in the cash market, FIs buy for 3 days in a row. In index futures as well, they've been covering their short positions over the last 5 to 6 trading sessions. If you look at it, we started April 9th with about 22% long exposure. Now that's gone up all the way up to 30%. Shorts coming by lower by almost 40,000 contracts. And levels that we're looking at lower levels, we have strong support at 23,650 thereabouts, because the 23,800 put is very active. 23,850 call tells you that maybe at around that 200-day moving average mark, we might see a little bit of supply. But if that were to hold on, then there are positions for this expiry which are expecting the Nifty to go all the way up to 24,250, 24,300 thereabouts itself. Put call ratio is at 1.16. Remember, nearly 1.2 is where we see the market being a little overbought. Even though we've rallied, we're a slight distance away from being overbought. And a couple of stocks that I'm watching out for today. We have Angel One, which has entered F&O ban after the result-related move. And we have Birlasoft, which is out of F&O ban. So those are a couple of counters I'll be watching out for today.
Thank you very much for that. Let's get to the equity calls then. Sayan Mukherjee of Nomura expects the Nifty to trade in a range of 17 to 20 times 1-year forward earnings multiples. They say they reset the March 2026 Nifty target to 24,970, which is based on a 9.5 times FY27 estimated Nifty EPS of 1280. After factoring in a 5% cut to current consensus estimates, he says they raised the target valuation multiple from 18.5 times to 19.5 times to factor in the drop in yields, assuming no material increase in risk premium. Science says in case of a stable risk environment, they expect FII flows to be supportive after the intense sell-off over the last 6 months. He says their portfolio stance is selective with a preference for domestic businesses.
Ed Yardeni is with us, President Yardeni Research. Ed, good morning. Great to have you with us here. Thank you very much for your time.
Sure.
Ed, I just want to start with something we don't talk about very often, which is gold. A best start to gold since the 1970s, 7% since the tariff pause. Well, that's great news, but gold typically goes up in times of uncertainty. So if gold is doing so well, can everything else do well as well?
The answer is probably no. I think gold has to be in a portfolio as an offset to all the turbulence and uncertainties we have impacting all the other markets, the financial markets. Certainly stocks and bonds have been volatile, and as a result of that, I think owning some gold, maybe a lot of gold, to offset that volatility is an important thing to have in one's portfolio.
Okay, so I mean, this kind of sharp move, not exactly a great thing, right? I mean, in terms of just if you're trying to gauge what kind of sentiment is.
It depends if you own it, it's fine. We've been recommending positioning in gold since it crossed above 2,000 last year, and just looking at it, at kind of the channel that it's in, it could get to 4,000 by the end of this year. And if it gets to 4,000 by the end of this year, I'd say the momentum could carry it up to 5,000 next year. And that's just a bet that if Trump is going to upend the old world order, and now what we have right now is the new world disorder, nobody really knows how this will all play out. And that could be a protracted period of uncertainty that's been unleashed by Trump's tariffs. So I think gold continues to do well. I do believe that there's going to be some resolution of this tariff issue by July 1st. Remember, on April 9th, the president postponed the reciprocal tariffs until July 1st. I think there's going to be some good news along the way, and that should help the stock market. But I think gold will do well because central banks continue to buy it.
Ed, I was talking to somebody on Friday and we were just chatting about what's going on. He said, well, the failure, it's the inability to make money in the market is now just a failure of imagination, a lack of imagination. Because who knows, right?
Imagination. It's always good to have imagination. But look, it's
no. My question is this. I mean, this entire question of what happens. Trump constantly threatening to fire. Not threatening to fire. He says, "Well, he'll be gone if I want him gone." Now, if something like that were to come to a bit of a head, what happens? I mean, what's the thing to do? Gold? So the conversation was in that context. So I just wanted your thoughts there.
Well, look, right now we have a trade war. That trade war could turn into a currency war. And in addition to that, we have the potential for actual wars. There is a war going on between Russia and Ukraine. The Middle East situation remains on the boil. It's conceivable that there still will be a military choice made by the United States and Israel to neutralize the nuclear facilities of Iran. And of course, China and Taiwan is a major issue. Before the election, Trump was interviewed by the Wall Street Journal about how he would deal with Taiwan. And he said he wouldn't do it militarily. He would just slap a huge tariff on China if they tried to invade Taiwan. Well, the problem is he's already played that card. He's already imposed a huge tariff on China. So China now, from a geopolitical perspective, say, well, what else could he do? What else could he do to hurt us? Let's go and instead of practicing a blockade of Taiwan, let's implement it.
Right. Purely out of curiosity, how much of gold's outperformance would you attribute to its own outperformance, in the sense that a lot of people are buying gold because it's doing well, or how many of them are buying because of the uncertainty in the world? Street is worried about the financialization of gold, so to say. Yeah. They've started looking at it more as a positioning than any sort of protection from the uncertainty that we're seeing. So I want your thoughts on that. And, while everyone's moving towards gold, are there opportunities in any equity markets in the US or the world?
Well, I think what you mentioned before, that sometimes investing could be just simply running out of imagination. Doesn't seem to be any rush to be loading up on stocks here, at least in the United States. It looks like we're going to continue to kind of churn here, maybe be very choppy to the sideways. Bond market looks like it's, despite its volatility, it looks like it's settling in around 4.5%. Meanwhile, as you said, gold is a hedge against all sorts of things like inflation, like political uncertainty, like global chaos. And we have all those things in place right now that continue to favor gold. Clearly, it could kind of feed on itself. And, it's interesting that recently it's gone up faster, almost at a parabolic pace. And that's usually an indication that it's due for some sort of correction, because somebody's getting in at the top, at least on a short-term basis. But I don't think this is a top. I think if there is a correction, it'll be an opportunity. I think there's a potential for gold to go higher. Again, simply because there's a lot of central banks of countries that don't like the United States, don't get along with the United States. They really just don't want to have dollars in their reserves. So they're going for gold, they're going for euro right now.
Ed, we're at the mercy of all the trade negotiations. Last week, it was Japan holding high-level trade talks with the U.S. This week, it's South Korea, visiting the U.S. with trade negotiations in Washington. In the emerging market basket, what is the approach now, and where does India feature?
Well, I think India is right at the top of the list of countries that the United States wants to have a deal with. The thing is, it usually takes a year or 2 years to negotiate trade treaties. There's so much involved. I think in this case, the administration would just like to have a piece of paper that's signed by various countries agreeing in principle to certain things, like reducing their tariffs, like reducing their non-tariff barriers to trade. And I think the United States will get that. I think the president is going to declare victory by July 1st. And with regards to India, I think that'll be the case as well. I think what's happened very helpful for India, certainly in the stock market, is a realization that unlike China, India has a much greater potential for growth domestically, whereas China's got the demographic issue is a negative. In India, the demographic issue is a very big positive.
And this despite the valuations at which India trades at right now?
Well, look, there's a lot of money in the global system that would like to be invested. Not everybody wants to be putting it into gold. Not everybody wants to be putting it into treasury bills. And meanwhile, U.S. stocks are still relatively expensive and volatile. Bond markets become somewhat more unpredictable. The whole concept of U.S. assets as a safe haven is being challenged right here. So, yeah, I think global investors are willing to pay up for India because they perceive that India is maybe has a more stable economic outlook and a more positive economic outlook than maybe many other countries around the world.
That point that you said, right? He just wants to declare victory, he's put tariffs so high that he's got so many ways he can declare victory, right? He can declare victory at, if the tariff is 150, he can declare victory at 125, 100, 95.
Doesn't really matter.
It doesn't matter. He can do it. Absolutely. So in a way, someone we were speaking with, I think 2 weeks back, said maybe, it's hard assets and EMs. And in EMs, India is right at the top in that sense. Make sense, Ed?
Yeah, I think there's a lot of things that don't make sense right now. And I think that the whole tariff issue we're all confused about because we really don't know what the administration's end game is. It's not even clear that the administration has an end game. So in this kind of environment where people are looking for some certainty, for a while there, it looked like they were jumping out of U.S. assets and going into China and into Europe. Now I think there's a realization that, well, wait a second, these are the areas where the trade war is most intense, and less intense is probably going to be the trade war between the United States and various emerging economies, especially India.
All right, Ed, very good conversation and very good primers to start the week with. Thank you very much for joining us and running us through your views and your perspective. Well, let's quickly run you through what's coming up here in the next 2.5 hours or so, what's lined up. So at 8:30, you will hear from Prakash Devan, and he'll be talking individual stocks. Lots to discuss there. 9 o'clock, you'll hear from Bhavin Shah of Samiksha Capital. IT is in focus, and Bhavin is one of the sort of not oldest, but the most veteran kind of IT analyst, of course, runs a fund now. 9:20 a.m., Pankaj Murarka of Renaissance Investment Managers will be with us on markets. 9:30, Angel One reported numbers. And we'll, of course, talk with Dinesh Thakkar about what the quarter is looking like. At 9:40, we've got a discussion coming up on the India-US bilateral trade talks. Remember, as we said, the India team is in the US this week. A little later at 9:50, Quarter Se Quarter Tak and Digant Haria of Green Edge Wealth Services will be with us to tell us what to expect from the NBFCs in the quarter. And towards the end, it's the economy with Lata in conversation with Santanu Chakrabarti of BNP Paribas to discuss the quarter gone by for big banks like ICICI and HDFC.
Right, with that, we'll take a short break. But as we do that, on the other side, there is a bunch of stock-specific action to track. We'll get to it in just a bit in our top 10 segment. We'll be looking at HDFC Bank, of course, post results, Infosys, ICICI Bank, HDFC Life, Mastech, a bunch of result reactions. Then we have Adani Ports, Divi's Labs that are on our radar on the back of positive news flow. On the other side, we have Eternal, which is Zomato, Tata Elxsi, and Oberoi Realty stocks that are likely to open in the red.
Welcome back. It's a Monday morning. We've got lots of stocks to navigate through, many on the earnings front. Our entire team is standing by for CNBC-TV18's list of top stocks for the day. And first up, it's Abhishek on HDFC Bank. Abhishek, how did the numbers look?
Well, strong operating performance if you see from HDFC Bank, especially the core operating profit. P&L, both the NI and PAT is a beat on our poll. NI beat of about 4.2% and PAT beat of about 3.3%. So the core operating profit, that is operating profit X of Treasury, grew by 20.5% YOY and almost 5% sequentially. The net interest margin on total asset is at 7-quarter high of 3.54% versus 3.43% in the previous quarter. This has a one-off with respect to 5 to 7 basis point on IT refund. However, X of that also at 3.46% versus 3.43 in the previous quarter. The net interest margin trajectory has improved versus the expectation of 2 to 3 basis point decline on net interest margin. Asset quality continues to remain impeccable amongst the large caps, and it has improved in this quarter as well. Both the gross NPA ratio and the net NPA ratio have declined on a sequential basis thanks to lower than estimated slippages coming in from them. Back to you.
Right, Abhishek, thanks a lot for that. We also got Infosys, so it's Nifty Bank and Nifty IT, both of them on our radar. Rima, how did Infosys numbers look?
Well, numbers were disappointing. The guidance was lower than what the street was anticipating, but just take cues from the Infosys ADR.
Yes.
Infosys ADR was down 2.6%, but in after hours, it was up 2%. And this is the brokerage reaction to the guidance. The guidance for FY26 is 0 to 3% on the top line. Margin guidance is 20 to 22%. As you can see, the guidance is lower than what the street was anticipating. But this is what JP Morgan says. JP Morgan says the FY26 guide of 0 to 3% is below prior expectations set 3 weeks ago. But it's better than the recently feared post the tariffs and the uncertainty impact flagged by Wipro's print. Citi too concurs that FY26 revenue guidance is decent in the current backdrop, though at the higher end, it does look aggressive. So in a nutshell, it does appear that yes, it's weak. The print is weak. The guidance is lower. But compared to the sentiment that was in the market towards tech in the last 1 week, it doesn't appear to be so bad. Now let's get to the Q4 numbers. Revenues sharply lower. Constant currency revenue down 3.5%, lower than expectations and lower than what peers like TCS and Wipro reported. The company also missed achieving its FY25 guidance of 4.2% at 4.2% after the Q4 miss. The positives in the numbers were the margin performance. The EBIT margin performance at 21%, slightly better, and deal wins continue to remain fairly intact at $2.6 billion. Also bear in mind, the stock is down 24% since the start of the year.
Well, so yeah, price damage, a lot of price damage from the beginning of the year. Rima, thanks very much for that. And we'll see what happens as things open up. The backdrop for the market per se is not all that bad, so keep in mind that as well. ICICI Bank is the other one. Stellar numbers once again. Abhishek is here with details. Abhishek, morning.
Morning, Prashant. So on the weaker side was the loan growth for ICICI Bank. However, P&L is healthy and asset quality continues to remain impeccable. Continued improvement trajectory seen over there. So P&L versus our poll, the NI was 1.5% ahead of our poll, and PAT was about 5.5% ahead of our poll. Now, what didn't work in the result? The deposit growth of 14% YOY is perhaps one of the weakest growth that you are seeing in last 8 quarters. But look at the industry as well, growing at 10 to 11%. That augurs well. However, advances disappointed. Advances growth is at just 13.3% YOY and about 2.1% sequentially. Now, YOY, this is the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, it's the weakest growth that you are seeing in last 5 quarters. ICICI General as well as ICICI Sec, they saw their PAT decline both YOY and quarter on quarter. Now, what's worked in the result? The net interest margin is at 5-quarter high, 4.41% versus 4.25% in the previous quarter. They have given the quarterly highest ROA, that is return on asset, coming in at 2.52% versus 2.36% in the previous quarter. Cost to income ratio is one of the best that you are seeing in last 19 quarters. So 19 quarter low operating efficiency, 37.9% versus 38.5% in the previous quarter. Even the quarterly annualized slippage ratio is at 17 quarter low of 1.53% versus 1.85% in the previous quarter, and that's helped the asset quality improve as well. Gross NPA ratio is down to 1.67 versus 1.96% in the previous quarter. So P&L and asset quality auguring really well for them. However, loan growth was weak this time around. Back to you.
Got that. Thank you very much for that. It's over to Yash now for HDFC Life.
Well, Reema, the numbers are broadly in line. In fact, there was a margin improvement which was seen in the fourth quarter for HDFC Life. Total AP saw a slight miss as compared to what the CNBC-TV18 poll estimated. I'll take you through the exact numbers. The total AP grew by about 10% on a year-on-year basis. It came in at about 5186 crore. As I said, it was a slight miss to what the street was anticipating. Value of new business broadly in line. It grew by about 11.5%, came in at about 1376 crore on a year-on-year basis. As I said, there was a margin improvement. The margins were higher, of course, on a year-on-year basis, as well as against what the street was anticipating. They were up by about 40 basis points at 26.5% versus 26.1%. I'm going with green on the stock simply because there was a beat which came on the margins, but also the street needs to be cautious. The management has not given exact numbers but guided for the first half of FY26, where they say that the base impact and volatility in equity markets would mean that first half of FY26 could remain soft for the company.
Right, Yash, thanks a lot for that. So the VNB margins may support HDFC Life Insurance stock today. Reema, what can you say about Mastech and weak numbers coming from Tata Elxsi?
Indeed, let me start with Mastech. Now, Mastech's revenue performance was not bad, especially compared to what peers have reported, though margins came in lower. The company's top-line growth was 2.9%. This we're seeing in context with larger companies which reported a sequential decline. That said, margins for the company dropped to 15.3%, lower on a quarter-on-quarter and on a year-on-year basis. 12-month order book went up by 7% and the company has cash on its books. But on the whole, top-line performance order book was fairly decent. Tata Elxsi was a disappointing quarter. The company's revenues declined by 5.3% on a quarter-on-quarter basis. Their EBITDA margins, profits also sharply lower. EBITDA margins at 22.9% compares with 26.3% a quarter ago, and profits too are the lowest that we've seen in the last many quarters. The company, in its assessment of the quarter, said that the automotive business witnessed challenges in the quarter as some of the OEMs paused new program starts in the face of uncertainty. Media and communication also saw some customer-specific issues, and overall, the industry continues to exercise caution on their R&D and innovation. So we'll watch for Tata Elxsi, but even the other ER&D companies, because if automotive is weak, right, for Tata Elxsi, automotive revenues declined by nearly 10% quarter-on-quarter, and the company is calling out that new projects were put on hold. That means companies like KPIT Tech could also have a fairly challenging quarter. So we'll watch for the others too.
Watch for Tata Elxsi, watch for KPIT Tech as well, but I'm watching out for erstwhile Zomato, now Eternal. The reason for that is the company has approached shareholders for approval of their foreign shareholding to be capped at 49.5%. Remember, this was expected because from the time the company raised about $1 billion via QIP, increased their domestic shareholding. This is what they wanted to do. Why is it that they want to do that? Because remember, currently the law prevents foreign ownership of multi-brand retail. Is the company in accordance with the law right now? Definitely. But what if in the future quick commerce is deemed multi-brand retail? So this foreign shareholding cap protects the company from potential regulatory risks around foreign ownership in multi-brand retail over the long term. So that's a long-term, medium to long-term positive. But in the near term, this is a negative. Why is that? Because capping the FPI holding results in exclusion from passive indices like the MSCI in the very near term, which means there could be outflows of almost $1 billion as per various quant analysts, and that could be a bit of a dampener on the stock or a bit of an overhang on the stock, the outflows coming in on account of passive flows.
All right, Mangalam, thanks very much for that. Adani Ports is the next one. Sudarshan is here with details. So good morning.
Morning, Prashant. So Adani Ports has announced the updates related to Australian port assets. Company will be acquiring about port holdings from Carmichael Rail and Port Project, and it's a non-cash deal and a related party transaction. Company will be issuing nearly 15 crore shares to Carmichael Rail, and that will help promoters' stake in Adani Ports increasing to around 68% from current holding of 66%. Also, analysts believe that the valuation that this deal is done at the old valuation of around like when it was in 2013, and that will be positive for the company because the valuation has not been taken as the increased valuation that the Abort Point Holdings has seen over the last 10 years. And this is done at EV to EBITDA of 17 times on FY25 estimated EBITDA of the asset. And what's the rationale of this acquisition? because this transaction is part of the strategy to handle 1 billion tons of cargo by 2030 that Adani Ports had given. Also, it sees 15% of 2030 cargo to come from the international operation, and the acquisition of About Point Holdings will play an important role in that part as well. And that's the reason I'm going with green for Adani Ports.
Thank you. And it's over to Vinny now for Divi's Laboratory. Vinny, what's the latest?
Good morning. So in terms of Divi's Laboratories, we do have a positive news that's come in where the company has signed a long-term supply deal with a global pharma company. This is mainly for the manufacturing and supplying of advanced intermediaries. This comes under the custom synthesis business. Now, this is expected to meaningfully add to the revenue of the company, as well as they're planning to invest 650 to 700 crore rupees in capacity expansion for this deal that they've signed. This is going to be mainly through internal accruals. As on 31st of December, the net cash that the company had was around 3,659 crores. So there's no problem in terms of cash that they have. The company is looking to expand its custom synthesis business. Last quarter, the growth in this segment was around 44% on a year-on-year basis. Contribution was around 53%. And this is what has been in the last few quarters as well, 40+% growth in this segment, as well as around a 50% revenue contribution that has come in, where they're exceeding and are hoping to expand this furthermore. So margins is something that could furthermore benefit if this expands further as well.
All right, Vinny, thanks a lot for that. With that, we go across to Ria, who is the newest entrant to our research team. Ria joins in to talk us through what's taking place in Oberoi Realty. Ria, welcome.
Well, yes, Oberoi Realty will be in focus today on the back of its Q4 operational update. Now, for FY25, the bookings value has gone up by around 31% over the previous year. But for Q4 specifically, we've seen the bookings value coming in at just about 853 crores in this quarter versus 1,775 crores that we saw in Q4 of last year. And we've seen a decline of almost 52% over the previous year. Even if you look at the number of units sold, we've seen good growth in FY25. But for Q4, we've only seen 78 units being booked versus 228 units booked that we saw in Q4 of FY24. So muted performance for Oberoi Realty in Q4, and we're also expecting some launches to be deferred to FY26. So expecting red on Oberoi Realty.
Thank you very much for that. And a quick recap then of the top stocks. Stocks with positive news flow are HDFC Bank, Infosys, ICICI Bank, HDFC Life, Mastech, Adani Ports and Divi's Laboratories. Stocks with negative news flow are Tata Elxsi, Eternal, that's Zomato, and Oberoi Realty. Well, nothing is shining brighter than gold over the last couple of days, and Manisha joins in bright and early this morning to tell us all updates on gold, the prices it's at, and where it's headed. Manisha.
Well, thank you for that. Absolutely. You know, every 15 minutes we are making a new high since the Asian markets have opened today. So currently we are trading above $33.85 an ounce. It has been one strong run. The year started with $26.50, so we are at $33.85 right now. It has been an $800 of a jump up that we've seen in the gold prices. Well, 2-3 things that have been supportive. One, the dollar index continues to decline. The U.S. president statements, whether it comes to negotiations, tariffs, has been keeping the markets uncertain. And the Trump statement on firing U.S. Fed Powell really led to a lot of buying as soon as the markets opened. That is what most of the buyers seem to be stating right now. So the prices are up 29%. Pardon me, in this year, and 45% up in the last 12 months when you look at the markets there. Not just gold, when you look at the metal prices, we've seen some gains here as well. So copper is trading 2.5% on the higher side right now. The markets also have seen stronger gains come back in case of steel and iron ore. What isn't doing so great right now is the crude oil prices. After gaining 3% on Thursday ahead of the long weekend, we're down nearly a percentage point at this point in time as US and Iran will reconvene on conversations and will draw a framework on the nuclear deal. That is something that's led to some premium of those prices.
All right, Manisha, thank you very much for that. So there's gold and there's oil in focus. We'll take a quick commercial break here. Prakash Devan with some fundamental stock conversation on the other side. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty indicating a mildly negative start, but that's really nothing given the sort of outperformance that India has seen. 2,100 points from the lows. The Nifty Bank leading the rally out here as well. Prakash Diwan joins in now. Prakash, good morning. It's the start of a fresh new week, but we had a bunch of news flow over the weekend as well. There was Infosys that came out with the numbers. We had HDFC Bank, ICICI Bank, and a bunch of these mid-cap IT names as well. So I'd like you to, weigh in on your opinion with HDFC Bank, point number one. Can the outperformance continue? And secondly is Infosys. Do you think the weakness is in the price?
Good morning, Mangalam. So, I think the today's session is going to be dominated by the salience in the private sector banks. That's already evident. And remember, this week you also have Axis announcing its numbers. So there will be a lot of expectations built in. And what these numbers tell you is that look at where the setup, where these banks kind of find themselves in the setup. You have cost of funds likely to come down. You have NPAs that have probably roughed out. You also have the fact that some of the banks like ICICI had retail loan books growing, which is very helpful because the margins are much better. NIMs have kind of steadied themselves in this band. So from here on, the market will look like very positively at allocating more money to these banks, and I think that will also benefit some of the largest PSU bank because their cost of funds has always been an advantage. And then I say the largest bank will probably be just the top three, which is SBI, BOB, Can Bank. But you will have a lot of the smaller private sector banks start participating in this reset on the allocation part. So it's going to be fairly good for financials. And while the BFSI vertical starts attracting attention and capital, remember you have even the Geo financial numbers have come, which in this challenging environment are pretty good, especially the top line growth. They've managed to start flexing. And remember, this is just the beginning. There could be a big scale up going forward. So I'm quite positive on the space as a whole. And my sense is Bank Nifty will probably lead the charge for whatever up move potentially is there on the Nifty. You'll have it because there's a lot of heavyweights that will do well among them. So that's very clear. On Infosys, my sense is it's most of these largest IT plays will probably go into a time correction, if not a price correction for the next 6 months at least till things ease out. And then they'll probably become better dividend yielding plays. So where 4%, 4.5%, wherever they are, is not a bad deal for people who are looking at the long-term accretion of dividend to portfolios. But I'm not still of the belief that IT will face some issue. Look at how Tata Elxsi got knocked up. It tells you the struggle that some of these otherwise leadership plays were enjoying. That's not available for them to grow. So we will have to be patient with the IT turnaround. But given the way the banks are leading the charge, I think that will become a very, very good play, at least in the next 3-4 months.
Got that. So time correction, maybe some price correction as well for IT. Banks looking good. I mean, ICICI Bank, amazing, right? I mean, I don't think there's been one quarter since Mr. Bakshi has taken over that the bank is disappointed. And he's kind of sort of managed to do that quarter after quarter after quarter. So let's see how this opens up this morning as well. Prakash, so many things to talk about, but let me just pick one from like a carryover from last week. The best performing large name last week was IndusInd Bank. Was up 15% in 3 days. Actually, it was all banks, to be fair. But IndusInd specifically, I mean, it's not so much a banking play, but it's a specific situation there, right? What's your sense on IndusInd?
Good morning, President. So I do agree. The findings were not as disappointing as what was anticipated, and given the fact that the management itself had anticipated the losses to be far bigger. The market already penciled that in, and it came in as a little bit of that relief. And when the entire sector is getting re-rated, it was one of the most damaged, fractured stocks. So there was a little bit of that action. But for all you know, today the Yes Bank numbers can get a lot of people excited because everybody has this whole thing saying, what's the next quick up move. And there's a lot of trading mindset that's at play, Prashant. It's not, I don't think IndusInd is being bought for a long-term, reset. It's probably a, quick recovery that everybody was anticipating, and that's played out. I wouldn't really bet on that to continue. You may have the likes of IDFC and all actually get into a little bit of a prominent trade spotlight because of the fundraise that they've done, the kind of numbers that could improve year on. Because this time around, the money is not coming from too many investors who you had to push the equity to. You got the money from just two large investors who would have seen the unit economics, seen the kind of numbers on the ground improving. So I possibly would believe that you'll have other banks feature. IndusInd probably is done its bit last week, and it was quite stellar and quite surprising to my understanding. So I would keep away from those kind of trades. But you will have these other banks which will start kind of getting into the spotlight.
Prakash, you set us up perfectly for the next question. You spoke about people wanting a quick buck, trading mindset, and something not necessarily fundamental. What's really taking place is Gensol, with the kind of price erosion that we've seen on the stock, the kind of worms that have that have come out of the can. The stock down about 5%. The street believes that there are some buyers for the Blue Smart business. After this sort of price damage, after the news that has come by, and after the news that is likely to come by, would you advise anyone to even dabble in names like this?
Oh, absolutely not, Mangalam. See, the potential interest in buying, I don't know whether it was Eversource or somebody that I read over the weekend, would have their own reasons to, buy, and there would be assurances which you and I as retail investors may not be able to enjoy. And in that process, it's extremely skewed, against investors, retail investors to participate. So I think it's going to be largely a structured transaction which will have its own bells and whistles for whoever wants to buy it. Because on the other side, the existing investor base is fairly strong and influential, and I'm sure at some point in time, that part of the business could be looked very differently. But the overall business doesn't make sense at all. It's a falling knife. Why do you want to kind of even hazard that, especially when there's so much of value available elsewhere?
In fact, let's get to that story, because sources revealed to CNBC-TV18 that Eversource Capital is in talks with Blue Smart for a possible acquisition. Parikshit joins us with more on this. Parikshit, what have you picked up?
Well, yes, we believe that Blue Smart has been in talks with Eversource over the last few weeks for a possible stake sale, and we believe that now the talks are at an advanced stage for Eversource to acquire a majority stake in Blue Smart Mobility. Now, this could be a transaction for around 800 to 850 crore rupees. So the discussions are ongoing. We believe it's in a positive direction, but as part of the deal, it's possible that Eversource may want Anmol Jaggi, who is in the board of Blue Smart, to step down as well. Now, he has around a 24% to 25% stake in the company. We need to see what happens to that. But clearly, Eversource wants both Anmol Jaggi and Puneet Jaggi, who were among the co-founders, to distance themselves from the company if this transaction happens finally. Now, a final deal could be announced in the next 2 weeks. So negotiations are happening at a fast pace. This is also coming at a time when Gensol has leased around 5,000 cars to Blue Smart Electric Mobility. Now, Gensol is facing a probe, not just by SEBI, but now by the Ministry of Corporate Affairs as well. So the company, of course, facing heat on multiple counts, but the focus now is on Blue Smart, and we believe that the founders are keen to sell a majority stake in the company at the earliest so that all pending liabilities can be cleared as well.
Looks like this is about saving the business. The business of Blue Smart per se. And Parikshit, thank you very much for that. And we'll see how this transaction goes and get you updates as we go along as well. But with regards to what you should be doing with Gensol, I think you heard that loud and clear from Prakash coming in there, that view. Prakash, just a few other names I wanted your thoughts on. Last week, as the market came up, a lot of mid caps, small caps also started to recover. I don't know if you have any thoughts on names like Delivery, which was up some 15% last week. Big beaten down names, basically. SW Solar was up some 16%. There was Home First, which came up some 14%. Anything which stood out?
No, so I would look at what the underlying theme that's emerging from these moves, and not necessarily these moves in absolute terms. The fact that there will be a lot of money coming in, and you've seen FIs turn positive towards India. It's going to be primarily domestic focused businesses. I mean, you have a delivery which has got nothing to do with external tariffs. You've got SW Solar beaten down. We've seen how the regime is kind of looking more positive than ever before. Though there were doubts in terms of pricing of certain supplies and all of that, but the Wari renewable numbers actually tell you a very strong picture emerging. So I think essentially what's going to happen is all these domestic facing stocks will actually get re-rated, and some of them are down 40, 50, 60% from their highs. So even if they don't go back to the highs, which I hope they don't, because that was too elevated and risky in that sense, you'll probably have a lot of the earnings catch up happen faster here, and hence the forward PEs will start giving you that comfort. So a lot of capital will come in there. I mean, simple question, Prashant. If fresh money has to be allocated into the market, where do you put it? And it's going to be these kind of sectors and names, and that's exactly well. So you'll have a smattering of names of the next few weeks that I believe will participate, and the Nifty might not move as quickly to its new highs or closer to the earlier highs, but you'll have the broader market see a lot of this participation, and that's the opportunity.
Is there any particular thing that you like in there?
Maglam, there are quite a few which we have narrowed down on, but to be fair, we're also kind of looking at the news flow to participate. But yes, I can tell you very simply, a lot of the PSUs are looking positive, especially in the power space. A lot of the domestic facing consumption names, discretionary consumption names, which will start perking up. You look at some of these FMCGs, look at some of the pharma names, and all this news flow always gives you the opportunity to buy. So that's why it's a bit tactical in terms of when to buy these stocks, even if you identify the names. So that's why I'm refraining from talking specifically about these stocks at this moment. But I think lower levels will give you that comfort in terms of the risk-reward setup.
Prakash, do stay on. Need to slip into a short break. On the other side, we'll get chatting about technical. Sudarshan and Mitesh join in. Stay tuned.
Welcome back. There's 7 minutes to go for the pre-open session. Let's welcome in Sudarshan and Mitesh, who are with us with what they'd want you to do with regards to the markets and specific stocks as well. Gentlemen, good morning. Mitesh, what's the view and what are the trades? Let's start with indices first. 6 sessions, 2,000 points in the Nifty, and the mood generally remains constructive still.
Morning, Prashant. See, I think, the first index I would like to comment upon is the Bank Nifty. Now, last time when the Bank Nifty was trading around these levels, we got the highest weekly closing at about 53,830, and this week we closed above that. Similarly, the daily highest closing was around 54,375, and we practically closed about only within the 100-point range of that. So maybe around these levels, you might see some pullback, some profitability. Also is the fact that the Bank Nifty has run up a bit away from its short-term averages. The structure is extremely positive, and I think I'll look at much higher levels. But in case there's a pullback which comes in, I think any decline to about levels of 53,800, 750 zones would be a wonderful entry opportunity on the long side. And I eventually expect the markets to get past 54,300, 350 zones and head towards 55,000. So very positive on the Bank Nifty. Similarly, a similar kind of positive outlook on the Nifty. The only thing is that the Nifty will tackle its 200 average at about 24,050. So you might see some supply coming, especially in the light of the fast rally which has happened. So around 24,050 is the first near-term target, but I'm actually looking at 24,200 as the logical target, and in a good case scenario, 24,800. So positive on both the indices.
Take that point, Mitesh. Thanks a lot for that. In fact, we have Sudarshan as well. Sudarshan, you've been recommending a positional long for a fairly long time. For those who wouldn't have acted upon that, would you say that the best of the gains are behind and maybe they should pause before taking any trading action in the very near term?
Yeah, good morning. It's very difficult to say that the best is behind us or in front of us. what we can say is that the trend is up. So if the trend is up, you must be a buyer in this market. Now, it's anybody's guess whether that trend will dissipate today or it will continue. I don't think we can predict that. There is no sign that the trend is getting exhausted. It may pause, as you said, whether can it pause? And yes, absolutely. Because after that big run up, the markets do need some rest. But that pause, if it comes, should be a buying opportunity. Today's dip is a buying opportunity. The rally we have seen and the gaps we have seen tell us that that is very strong upside momentum. So let's go with it. Be a buyer wherever you can.
And what stocks?
All right, the stocks. This time, it's luckily the Nifty itself will reward more than the stocks. LIC is a buy with a stop under 785. M&M is another buying opportunity with a stop under 2620. HCL Tech is a try, well, it's a buy on dips really, but buy with a stop under 1410. And Auto Pharma is a buy with a stop under 1140. The theme is that this is not a market which we want to challenge. We go only north.
Right. And Mitesh, your stocks?
Yeah. Morning, Mangal. I have a buy on ICICI Bank with a stop at 1385 for targets of 1445. Now, this one might open in the gap up. But then Indian Bank is also a buy. Keep a stop at 564. Look for targets of 600. A buy on delivery around 278. So if you get a morning kind of a pullback, enter around 278 with a stop at 271 for targets of 295 and a short clearing. That's a buy with a stop at 214 for a target of 228.
All right, gentlemen, thanks a lot for that. Delivery has been a big mover in the previous trading session itself. That's likely to continue as per Mitesh. With that, we'll take a short break, come back. We have the pre-opening and also we have Bhavin A. Shah of Sameeksha Capital to review the fourth quarter IT sector earnings so far. How much of that is in the price? What should one do? All right, you're watching us here from the CNBC-TV18 Motilal Oswal studio. This is Open Exchange, about 30 seconds to go for pre-open, 15 minutes to go for the market to open. The GIFT Nifty indicating a mild dip at the open itself, which our technical experts are suggesting use as an opportunity to buy itself. We've been speaking to Prakash Diwan. Prakash, you spoke about a bunch of sectors and a lot of stocks as well. I want your thoughts particularly on the pharmaceutical space, because this morning there's news about Divi's Lab inking their drug supply agreement close to around 650 to 700 crores, the capex on that. And then there was Cipla as well. One of their units in Goa has been classified as a voluntary action indicated by the US FDA, which is one of the milder of the classifications, which means it is a positive. In the kind of decline that we've seen in the pharmaceutical stocks and the impending tariffs that may come for the pharmaceutical space as well as promised by Donald Trump, how do you view this space and what would your bets be here?
So, I mentioned this earlier, Mangalam. Pharma as a space, while it offers value, is got this massive overhang that you mentioned about of impending tariff-related announcements. Now, we really don't know whether actually tariffs come, given the way tariffs are losing their, bite in terms of being a tool to negotiate. But my sense is the best way to play pharma at this point in time, and this is a little bit of a global thing. Remember, there are lots of other positive news flow around pharma globally that's also perking up the sector in Europe, particularly. Eli Lilly's got some announcements. Even some of the Ozempic plays getting active. I would play this with the picks and shovels, theme where anybody who's looking at market reset and geographical footprints being reshuffled will benefit if you look at a company which is called Indegene in India. Again, a very unique business model. I don't think it has a peer. There are a couple of global plays, but then they are very niche in that sense. Everybody has their own strengths and niches defined. But Indegene is the one that uses a lot of intelligence, a lot of insights and input empirical data to support which drug you should be launching at what point of time, given the pipeline, given the maturity levels of that cycle. So, it's a very simple business, but very complex to execute. It's simple to communicate, and I think that's the kind of business which will start seeing a lot of salience, irrespective of what happens to tariffs and some of the specific names that you mentioned. So I would play it a bit safe, and I still find a lot of value given the way it's kind of behaved after its IPO, which was just about a couple of years. So it doesn't have a great history, as in a long history. But my sense is, as institutions understand the business and get empirical data or some track record to build on, you'll probably see a lot of interest in this. So keep a watch. Let's hope they deliver the numbers that are being anticipated. My allocation to pharma is probably restricted only this name yet.
Thank you, Prakash, for your thoughts and joining us on this Monday morning. The early rates in some of the IT stocks, Infosys down 3.5% and Tata Elxsi 2 down nearly 4%. Now, Infi's Q4 numbers disappointed the street. The guidance is 0 to 3% for FY26 is lower than estimates, but as some analysts pointed out, that perhaps the street was fearing a lot worse over the last 1 week. But let's talk about Tata Elxsi because their performance has implications for other companies like a KPIT Tech or LTTS. Now, Tata Elxsi has reported the third consecutive quarter of a miss. Their revenue drop of 5.3% is the worst sequential drop in the last 5 years. Their margins have now fallen in 8 out of the last 9 quarters. EBITDA margins now stand at 22.9%. Profits are down 13.5% on a quarter-on-quarter basis. The problem is that transportation, which is about a third of their overall revenues, has seen a drop of 10% sequentially, and therefore you should watch for companies like KPIT Tech. Tata Elxsi management says the automotive business witnessed challenges as some of the OEMs and suppliers have paused on their programs, and media and communication is also another vertical which has been impacted. Now, Tata Elxsi used to command very high valuation multiples of 50, 60 times. But as growth rates for the company slowed down, we should pull up the annual growth rate. In FY22, FY22, the revenue growth rate was 35%. That's when it used to command the peak valuation multiple post-COVID. This came down to 25% in FY23. In FY24, it was about 9.5%, and it's further down to 3.1%. There you have it. This is the annual revenue growth rate for Tata Elxsi, and since then, the stock has been getting derated, but even now, it stands at close to about 30 times forward multiple. Now, is it expensive or is it attractive? So watch for Tata Elxsi and other ER&D companies. Bhavin Shah is now joining in. He's the founder and CEO of Samiksha Capital, but he's been watching IT for the last so many decades now. Bhavin, thank you very much for joining in. Before we get to Tata Elxsi, first the big one, Infosys, and give us a summary of what we've seen from TCS, Wipro and Infi now.
I think there is increased uncertainty and weaker outlook from these companies. That is what I can see, and I think the commentary guidance is confirming that, and this is perhaps not even fully accounting for the potential weakness that we might see in the sector. And I think we have already seen the growth slowing down last year. I think Gen AI is kind of causing a new equation. Many of the past transitions or technology shifts were positive for Indian IT services, whereas AI is potentially negative, and I think that is where the issue is. And then on top of that, we add the economic uncertainty that has come up because of the tariff war. So I think in summary, it is and I compare current situation to start of COVID, because valuations from my standpoint, at least from a cash flow perspective, are similar to the start of COVID, almost there. But I was very positive and very excited about by owning the stocks going into COVID. I don't think that excitement is there today. There is still a fair bit of question marks on the growth outlook.
So what are you advising clients now? Should one be owning IT at these levels? And if they do have IT, is it time to trim? You want to say something?
No, I was just saying, sorry, Bhavin is his own client. I mean, he's
managing money. He's managing money. And so what's the call now on?
Yeah, so what I can say is that in our portfolio, we don't really own much of IT stocks. We have very, very small exposure. We have found the sector to, the stocks to be fairly expensive for the last some time. And while they are getting attractive, as I say, but the growth is a question mark. So we would continue to sit away, and if people still have it, I think whether or not to trim here or not is a difficult one. But yes, if somebody's overweight, it is worth still going, correcting, especially in the expensive leg of the sector. Some of those mid cap names, which were considered to be high growth, and and both companies and the investors were extrapolating 1 or 2 years of super growth in COVID to sort of 5 and 10 years, and that is, I think, is reversing now. So I think unless you are seeing, and I'll give a simple thumb rule, unless you are seeing an IT stock available at 5 to 6% free cash flow yield, be careful. You probably will see more downside.
And what is it currently at? The free cash flow yield?
I think the likes of Infosys are at that number, but the question mark is growth. And I think, but some of the other ones, the mid cap high growth stocks are not that level yet, so there could be more downside.
So that's like a filter, starting point, right? In that sense, and then you talk about other stuff. Bhavin, good to see you, and it's been a while, and congratulations. I think your portfolios have done very well over a sustained number of years. And we'll talk more about what you are doing. But anything out there in terms of so much technological change, right? And how's any other places it's likely to show up? You track a lot of small mid cap stocks, etc. as well. And there were a few names on the IT hardware side, data center plays, etc. Anything which you like?
I mean, we are very much interested in finding value. We add as well as growth. Combination of that. So we have some exposure to companies that are more in the distribution part of the IT food chain. So not really affected by these technological changes, but in fact, increase in demand for some of the new hardware might even be positive for them. And they remain available at very attractive valuations. So we still own them. And I think the other aspects will be the IT related, you could say, not the KPO type of businesses, but they are catering to a very different, let's say, healthcare segment. And I think there, maybe there is still a fair bit of a growth opportunity. And so if the valuation is right, we would still own it. But I think overall, the technology is enabler in many ways. For example, I think changing the consumption pattern. Digital music is something we have liked before, and we continue to like. So we have some exposure there. And I think some of the companies that are basically platform plays, they have experienced lower growth. They act as an interface between the users of services and the service providers or goods. And the slowdown in the economy perhaps has affected the growth, but then they are also available at very attractive valuations. So we own some of them as well. So more domestic play, I would say, in that context than companies. I mean, I think we have kind of done a scan through our portfolio to see how much is the exposure to for example, the US, and we try to kind of stay very low on that right now.
All right, Bhavin, thank you so much for joining in. I was curious about the digital music plays. There are two listed names here. We'll talk to you about that in detail on another occasion. But as of now, thank you so much for your call on the IT sector. Let's get in. It's 9:10. Let's get in Sudarshan and Mitesh back for their pre-open 9:10 calls. Sudarshan, you go first.
Well, M&M is a buy. Consider buying M&M with a stop under 26.20.
Mitesh?
I'll go with the buy on Indian Bank because that's a stock which could do well and get towards 595, 600 for very fast.
Okay, let's get to some of the stocks you should watch as we await the market opening. Sudarshan is now joining in on GAIL.
So PNGRB, that is the regulatory body, has floated the consultation paper for the tariff review of the pipelines of GAIL. Remember that GAIL has around 10 pipelines, and on that, stakeholder has to reply to GAIL by May 1, and GAIL has to reply to PNGRB by May 15. So what was the GAIL submission? GAIL had submitted the tariff hike to rupees 78 per MMBTU, and after queries from PNGRB, that was revised lower to rupees 77.43. Now, GAIL had spoken to us last month, in which we did ask the same question, what was the tariff quantum hike that GAIL is expecting? And that GAIL had said that it had submitted for the tariff to be hiked to rupees 78, but even if the approval comes for around rupees 70 per MMBTU, GAIL would be happy. And following that, CLSA has written a note on the GAIL, and it has upgraded the stock to outperform from whole, and target is increased to rupees 210 from rupees 175. It said that it's expecting a tariff hike in the June board meeting of PNGRB, and it's expecting a hike in the range of 20 to 25%. Also, it has increased EPS estimates in the range of 9 to 19%, and it believes that it's the start of the review process, which raises its confidence for a tariff hike. So overall, it's positive for GAIL, and we can see an upside in today's trade.
All right, so thank you very much for that. Stocks up 2% at the end of the pre-open session. Now, wind as a space in some focus. Vivek is here to tell us why. Vivek, morning.
Well, good morning. Well, the wind energy sector will be in focus, especially wind turbine generators will be in focus. What has happened over the weekend is that the MNRE, which is the Ministry of New and Renewable Energy, has released a draft notification for RLMM for wind turbine models. RLMM is the revised list of models and manufacturers. What is this particular amendment or the notification all about? It mandates local sourcing of key components as far as wind turbine generation and manufacturing is concerned. What are these components? Some of the components mentioned include blades, gearboxes, generators, as well as towers. What are the key highlights? Number one, the Moon mainly aims to increase domestic content usage in WTG generation. Domestic vendors should be used for blade, tower, gearbox as well as generators, and this is going to be made compulsory. Also, the data centers have to be mandatorily located in India, and also the R&D centers needs to be located within India, and there will be a timeline of 6 months to go ahead and comply with these norms once it comes into effect. What does this particular move do? What is the main aim of this particular process? Number one, it will address concerns regarding competition from Chinese original equipment manufacturers. Remember, a player like Envision from China actually has an order book of close to 10 gigawatt, much higher of combined of Suzlon as well as Inox Wind, both of these players which will be in focus today. Also, there has been worries about potential loss of market share as well as pressure as far as WTG core margins are concerned. So the move will address both of these particular developments. So both watch out for both Suzlon as well as Inox Wind. Expect them to benefit from the domestic content manufacturing draft notification.
Right. Thanks a lot for that, Vivek. Those are a bunch of wind sector stocks on our radar. Less than a minute away from the market opening. The pre-open is actually settled a lot higher. So we have 7 seconds to go. Nifty looks like it will open a lot higher than what the GIFT Nifty indicated. The 97 points is what the pre-open did indicate. Prashant.
All right, well, we've got a decent start, about 1/3% higher on the Nifty. The Nifty Bank, I think, is at a record high.
Yes.
So 54,290 is where we are starting on the Nifty Bank. So that's at a new, the first index, the first big index to get back to its previous high. Of course, I mean, the Bank Nifty did not fall as much as the Nifty did. This entire decline, it's the fastest to come back, and we'll put that alert out in just a bit. Mid-cap index is up about 0.6%, 300 points higher. You've got... We've opened at a record high, so we should change that to not set to open, but opens basically. We got the other indices, the small cap index, which will come up, which is also higher, and it's an all-round good start, which is coming through. Market breadth very early, just out of the gates, but it's 1,000, 1,100 stocks are higher, 400 stocks are lower to begin this week. Prima.
Well, the Nifty is inching towards 24,000 level at open, and now all eyes will be on the 200-day moving average is 24,050. We've extended our rally for the 5th day in a row, and what's helping is positive earnings from the banking names. Perhaps all the bad news is in the price for IT names for now, because the Nifty IT index has also opened up in the green with a gain of about 1.7%. In fact, sectorally, IT is the top gainer. It's Nifty IT 1.7% higher, followed by Nifty Bank with a gain of 1.3%. Very close now to that 24,000 mark level, just 12 points away. The top gainers include in the large cap pack, actually the first three are IT names. So it's Tech Mahindra and HCL Tech. HCL Tech reports numbers tomorrow. Stock is up nearly 2%, and Tech Mahindra towards the end of the week, and that's the top Nifty gainer, 3% up. Infosys is higher. Infosys is opened with a gain of about 2.5%, so that's advancing. Remember, the stock had declined 24% since the start of the year, and analysts are pointing out that the guidance of 0 to 3% for FY26 is not as bad as what was feared last week. Following IT, you've got the banking names. It's a stellar performance by ICICI Bank. Brokerages are raising their EPS estimates. Stock is opened with a gain of 1.5%. HDFC Bank giving it company, and both HDFC Bank and ICICI Bank are at fresh highs. HDFC Bank inching towards a 2% gain. Axis Bank. In fact, if you look at the top 10 gainers, it's all IT and financials. So you've got, we spoke about some of the others. Some of the others included State Bank of India, Shriram Finance, Wipro, IndusInd Bank. IndusInd Bank continues with its rally from last week. This month now, IndusInd Bank has gained 24%. On the way down, it's Adani Ports. There is that acquisition that's weighing. Stock is down 3%. And then some FMCG names are weighing on the market. Tata Consumer, Asian Paints under pressure, Nestle, ITC down nearly 0.5%.
All right. And the broader markets, actually, the market breadth would have you believe that 4 out of 5 stocks in the markets are in the green right now. So for every one stock which is in the red, we have 4 in the green. We have a bunch of stocks which are actually doing well, and a lot of them having news backing them. So Yes Bank up around 6%, reported its numbers. The deposit momentum was strong, as was the advances, close to around 8%, which despite being slightly lower than the provisional update, the street's taking that with both hands, up 6% for that one. GAIL up 4%. Sudarshan had told us that, the PNGRB has, released a consultation paper for revision of tariffs, so that could be a positive. GAIL is up 4%. We have Just Dial as well. Even, the revenue growth was slower, 0.7% quarter on quarter, a 7% move year on year in terms of revenue has the street excited on Just Dial. Has been a beaten down name, up around 7% as we speak. Devis Labs is the one that is higher from the pharmaceutical pack. This after inking a drug supply agreement for which they will have to invest about 650 to 700 crores in capex. Oberoi Realty is of the 5 stocks, one in the red. Oberoi is one of them. Its fourth quarter bookings were down nearly 52%. FY25 booking value was up 31%, though the fourth quarter being weak has the street worried a little bit. The stock down by about 1.6%. But by and large, a fairly strong looking screen. We have Intellect Design Arena, Oracle Financial Services, Devis Lab, Bandhan Bank, Coforge, financial and IT in the mid-cap end of things doing extremely well as well. And then we have a couple of these names which continue to move in the direction that they've been moving in the past. Senco Gold, for instance, up around 5%. We're seeing some traction on the way up for names like Northern Arc and Kitex Garments as well. But on the way down, we have Gensol, which continues to decline, 5% lower today as well. The stock at 111.
Well, lots happening. Infi is now lost pretty much all of its gains. I mean, not all, but there's about $10 left on it. And I would say rightfully so. I mean, for the stock to open 3% higher, could have started flat and then gone up. But to open 3% higher, I think it would invite, at least traders would want to take a punt that the numbers are bad, the outlook is not all that rosy. I think just some trading action going on here more than anything else. But there is, of course, a lot happening otherwise outside of IT. And I think we mentioned bulk of it. Divis, of course, 4%. It's got very large volumes. Yes Bank is up 5%. Yes, with 5% is the largest volume-led gainer right now. And there is Axis, which is up 3%, 1,227. Actually, Axis is the number one volume-led gainer as far as the market is concerned. There's Kiri Industries, which is up 5. Inox Wind is up 4. Just Dial, I think we mentioned 8%, big volume gains. Ujjivan Small Finance Bank is up about 4%. Supriya Life Sciences, Senco Gold, and so on and so forth. But things are just picking up as far as volumes are concerned. out here. Adani Ports with a 2.25% loss is the number 2 volume-led loser right now. So 1,230 on Adani Ports is what we've got. And the big winner from last week was Goldium. I mean, big 250 to 350 very quickly in about 4-5 days. That's starting with about a 2.5% cut. There's Shelly Engineering. I mean, it's there are institutional investors here. It's down 7%. I'm not sure if there is any specific news flow here. Volumes are very, very thin right now, but 1710 or so is where Shelly is now coming in at. 95 on the Nifty, 23,950 on the index. Pankaj Murarka is with us with what he's making of the market, CEO and CIO at Renaissance Investment Managers. Pankaj, good to have you back here on the program. Prashant this side. Thank you for joining us. So, you know, the Bank Nifty is at a new high. And hopefully this time, last time the 23,800 breakout on the Nifty did not last. Maybe it will now. Mood's pretty constructive out here. What are you doing, Pankaj, at Renaissance? And just tell us your outlook, near to medium term.
Sure. Morning, Prashant. Always a pleasure talking to you. I think, Prashant, we broadly remain constructive on Indian markets. We've held that view. I've held that view that whatever correction or pullback we've seen in the last 5 or 6 months, it's been more of a bull market correction than a change in broader trend on the market. The fact remains that we're coming out of a cyclical slowdown in the economy last year, where last year, if you look back, March ending FY25, Nifty 50 earnings growth is just about 5%, probably the slowest earnings growth that we've seen in the last 5 years post-COVID. But I think that's in the base. Probably from here on, we'll see gradual improvement in earnings. Obviously, the world has seen that what lies ahead for the world is trade headwinds, significant trade headwinds. But probably in an environment like this, India is a relative winner because India is tariffed much lower than a lot of other competing economies. So that should help India slightly more medium term to long term. So our view overall remains fairly constructive from a broader market perspective. I think probably we should moderate our return expectations, but I still firmly believe that probably before the end of this calendar year, Nifty will make a new all-time high. So in that sense, we continue to remain positive on the markets.
What are your thoughts on IT? That's been the biggest drag since the beginning of the year. Growth is slowing down quite dramatically. But valuations too have corrected. And now some of the stocks like Infosys, for instance, is at its long-term valuation multiple. What's the call on IT, mid-cap and large-cap?
Well, as you rightly said, Rima, valuations have corrected and are pretty much, at least in the large cap companies, are closer to the levels where one would ideally want to invest into these companies. Having said that, we should concede that given the significant amount of uncertainty and these companies have called out that clients are holding back decisions. The biggest damage, I think, apart from everything else, and uncertainty around tariffs and what it does is it shakes CEO confidence globally. And once confidence of the CEO is shaken, obviously all investment decisions and everything is pushed back, and which is what these companies have even called out and they're experiencing where large deals or discretionary spends are pushed back. So I clearly think that the growth in the near term, at least over the next few quarters or probably next year, is impacted for the IT companies in that sense. There's a lot of fog on the windscreen and there's uncertainty. So until the fog is cleared, unlikely that we'll see these stocks performing. Having said that, as we said, in the large cap, at least valuations are far more reasonable or probably have become attractive. Some of the large companies are now quoting out or trading at dividend yields or free cash flow yields or earnings yields, which are as good as 5 or 6%. So probably that's the floor in terms of valuations for these companies. So I think it's time to selectively nibble, but I still think stock price performance probably would be more back-ended towards the second half of the year once fog on the windscreen is cleared.
Same of the consumption space. You know, valuations are not at long-term averages. They're still slightly elevated. And those long-term averages as well in the consumption space are elevated. A lot on the street believe that maybe the earlier axiom of FMCG stocks trading at a much higher multiple than the other parts of the market needs to be revisited. But on the ground, there have been signs of some recovery, especially on the rural front, and maybe some bit of incremental recovery coming in from the urban front as well, largely on account of all the SOPs that the government has given on the budget, etc. Do you believe that maybe some of these erstwhile companies are now taking charge, also looking a lot better than the D2C competitors, which have faced some sort of liquidity crunch?
Absolutely, Nigel. So I'm pretty positive, constructive, bullish, whichever way one way to frame it on the consumer stocks. Meaning, I think it's one sector which has underperformed big time in the last 5 years. If you look at post-COVID stock price performance, this is one of the biggest laggard sector. But I think after 5 years, we are getting to a stage where we are seeing early signs of recovery. And I think we are in for a very significant or meaningful recovery in consumption in the Indian economy over the next 2 or 3 years. Also, in a world where global trade is going to shrink, given that the largest buyer in the world, US, is going to withdraw, I think every economy or every country will have to look inwards towards driving growth. In India, we have stars aligning for a recovering consumption sector. One, we're coming out of a very low base of consumption in the last 2.5 years, where the PFCE, or as we call the private final consumption expenditure, growth has been about 5%, which is half of the long-term growth of 11.5%. More importantly, the government has done tax cuts in the last budget. That money will flow into the pockets of consumer. I think we're looking forward to a GST rationalization, which will again reduce GST tax on certain category of goods and again benefit consumption. And also, I think the rate cut cycle should also benefit consumption. So all of that, sum total, I think will lead to a meaningful recovery in consumption. So we remain pretty constructive. I think the two big sectors that I really think can outperform the market over the next 2 to 3 years is essentially private sector financials or financials broadly and consumption. So both these sectors have been laggard over the last 2 years, but I think they could be the leaders in this rally going forward as we build on this bull market from here on.
And how do you play consumption? Via traditional FMCG names, rural focused, urban focused, or discretionary names, or maybe entry-level auto names as well?
Well, given our growth bias for us, the natural bias is focused toward discretionary consumption. So we like names, and we own in our portfolio names like United Spirits and Jubilant Foods, to name a few, which we think will benefit as we see an uplift in consumer spending. But I would also say at this point of time, we are also buyers of staples as well, because for the very simple reason that we are coming out of a very low base of consumption over the last 2 years. When I said that, if you look at last 15 years, the aggregate private sector consumption or household consumption in India has grown ahead of nominal GDP growth. In the last 2 years, that growth is like half of nominal GDP. So because of very sharp inflation spike that we saw in the economy 2 years back, consumers have cut back on spending, including on staples. So now that inflation is moderating and there's rise in income levels, I think first thing the consumers will buy into is staples. So I see a very strong volume recovery in staples as well over the next 12 to 18 months. So at this point of time, our natural disposition is to own consumption across both staples and discretionary.
From your published portfolio, Pankaj, if you want to sort of talk about 2 or 3 ideas with full disclosure, what you're most constructive about, Pankaj, across the board. I mean, private, I understand financials and consumption, and we got into some detail there. But if you want to sort of talk about, overall, what you're most convinced about.
Yeah, so in a slowing economy where growth has moderated, I think the natural disposition for a growth bias investor like us is to look for outlier growth, which are the pockets of the economy where the growth can be significantly higher, and probably where can we make outlier returns. So clearly from our point of view, one we clearly see is capital markets or financial services as a sector which has strong drivers supported by savings and money moving into capital markets. So we own HDFC, AMC, and Motilal Oswal Financial Services to play the capital markets play. I continue to remain very constructive on the fintech opportunity in India. I still believe that 10 years out or 15 years out, one of the top 5 financial services company in India will be a fintech. And we've been holding Paytm for a long period of time. So I still continue to remain constructive. I think over the next 5 years, Paytm could do $1 billion of EBITDA. And I think some of these companies can actually lead to some outlier returns over the next, let's say, 1 to 2 year time horizon. As you rightly said, we own all of this in our portfolio, so the disclaimer follows.
No, full disclosure, absolutely. But good to put some names, right, to some of the ideas, as always. Pankaj, thank you very much for joining us. By the way, we have another fintech coming up in the next conversation, so you may want to listen in. I'm talking about Angel One, which is, of course, a capital market play, but, of course, expanding into many other areas as well within the capital markets and wealth management, etc. as well. Pankaj, thanks very much. So let's get to it. Mangalam, Angel One.
Angel One, the stock's actually done well. In fact, over the last couple of trading sessions, the result was weak as expected, largely because of the weakness that we're seeing in the market itself. The sort of regulatory issues that came by in the F&O space led to their F&O volumes declining by about 26% as well. Overall, there was a decline in their revenues. Let's decode the trends of the future with the company. We do have with us Dinesh Thakkar, who's the chairman and managing director. Remember, the stock from a technical standpoint did come out of the F&O, did enter the F&O ban as well, which explains the sort of up move that we're seeing out there. Thanks a lot, Mr. Thakkar, for joining in. Two things that I want your thoughts on in the very near future. One, you said that things are normalizing. You expect the margin band to return to that 40 to 45% by the fourth quarter. What gives you the belief that it will go there? Secondly, even as there was an impact in the F&O business because of regulations, it seems like you lost market share. So the impact was a little more on Angel One versus the others. What explains this?
Okay, first of all, what I had said, we will return back to kind of like normal financial ratios, that is OPM and all that, by fourth quarter, not first quarter. Fourth quarter of this fourth quarter of the financial year. So we have gone, I would say this industry has gone through a kind of a like perfect storm where whatever should go against this industry has gone. Macros, be it our economic growth, be it FIS not investing, and majority impact is because of regulatory changes, which has now, I would say, absorbed by retail investors. We saw a bottom in terms of number of orders in Feb. We did almost below 50 lakh order per day, which is kind of like minimum. After that, we are seeing slowly kind of like revenue curve is moving up. So March numbers were better in terms of 53, 54 lakh order per day. And we are seeing this trend continuing in the like this month also. So that gives me confidence that, okay, at least revenues are now, revenue come has turned for better. And margin expansion in digital company, what happens when we take a cost to build a platform? There is a cost to build a platform and maintain the platform that we have already taken. So today we have a platform which can serve an order up to 1 crore 40 lakh without much increment in cost. So whatever revenue increment we see in this progressive months, that will straight away contribute to our expansion of margin.
Mr. Thakkar, morning. This is Rima here. Could you give us an indication of what the current orders per day are? February was sub 50. In March, it was averaging 53, 54. What would it stand at? And what was the peak or the average, say, when things were going, all right for the markets?
So average number of orders that we were clocking was around 75, 78 lakh per day. So today, as we speak, like last March number, we have already disclosed that it's around 53 lakh plus. So that trend is continuing. So we don't disclose all this number. So maybe by month end, we'll disclose this. But I can say that a positive trend that started in Feb continues.
Okay. What about your F&O market share? Have you lost market share? What does it stand at? Yeah. What would you attribute it to? And what steps are you taking to correct it?
Yeah. So what happens when actually we talk about market share? Market share in retail comes from Ultra HNI, retail, prop desk and all that. So when we lose market share, it is that retail is less active. So you will see market share dipping a bit. So it is not a point of concern if you see a graph of like 12 months, 24 months. Few months there would be some dip because retail is not participating as actively as HNIs are participating. So it is not a matter of concern for us. We are seeing overall other parameters in terms of engagement on our platform and all that. We are seeing engagement of these customers is equal or better than what they were a few months back.
Mr. Thakkar, hi, good morning. Prashant this side. On the F&O side, sir, and we asked this, we put this question to exchanges as well when we get the opportunity. Could you give us, again, same kind of comparison? What was the high there in terms of F&Os on a metric that of your choosing? Where are we now? And just to give us a kind of a scale comparison.
So, like in terms of number of order, this quarter, we degrew, our growth was like lesser by around 21, 22%. So overall, whatever impact we have seen in terms of F&O order, On month-on-month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying, after this kind of stabilization in terms of our news that are coming and the FIs inflows that are coming in, it appears that retail is getting back confidence to come back to the market. So what we are seeing, if at all this trend continues for few 9 or 10 months, and customer growth rate that we are seeing, we are able to acquire in this bad condition also a customer base of around 5 lakh, 6 lakh per month, that will all contribute to expansion in margin in next 9 to 11 months.
You know, Mr. Thakkar, just to, and we'll sort of summarize this with the overall numbers as well. You've been very aggressive in terms of, by the way, Nifty has hit 24,000, Mr. Thakkar. So, that's talking directly, that's talking directly to your business. I mean, things have got to look up, right? I mean, it's just the way it is. For retail to come back, for optimism to come back, and of course, I mean, that is a direct impact on order flow, order volume, etc. So for now, 150 odd points on the Nifty, by the way, so 24,000, Nifty Bank hitting a new all-time high. So things are looking better, of course, much better. Mr. Thakkar, on wealth management, right? I think you've been, of course, you launched and you're growing rapidly. Could you give us a sense of what are you doing? What should the growth in AUM be? What are your targets for the end of FY26, say?
See, fortunately, we got a good team to manage our wealth business, and we were able to recruit top-class relationship managers and all that. And we just got licensed few months back. And in few months, we were able to get an AUM of around 3,700, of which 3,200 is asset under management. So difficult to set a target for this thing. So usually the way we function is that we are building a base right now. So what is important right now is that all processes are in place, relationship managers, they are aligned to products that we want to sell. So I am seeing a good acceptance of our products in the market. So we are very bullish on that vertical.
Right. Mr. Thakkar, as we speak, well, the Nifty is above that 24,000 mark. The IT pack is coming off lows. The Nifty Bank doing well. Reliance is the one which is powering that index ahead right now. Reliance reports its fourth quarter numbers on Friday. So we have Reliance, which has moved to the high point of trade as well. So that's about the market. Coming back on your customer addition, metric that you spoke about. In this market, you're able to attract around 5 to 6 lakh customers per month. Your customer acquisition costs have increased as well. So from the peak to now, how much do you think your customer acquisition costs have increased? And with retail perhaps likely to come back because the markets are making a comeback as well, how much would they reduce by? If you could give us a comparison on that one. At the same time, the revenues per order. In F&O, it has been coming down to around 21.2. And cash, it's increased to around 11.8 rupees per order. What's your outlook on these?
Yeah, on cost, there was a slight blip in the month of Feb and March. That is usually seasonal, and even Google has increased the prices. So we have brought that cost back in this month. So now it is again back to normal. And plus, as market were subdued, so definitely to acquire a client, it is becomes a bit costly. With market returning back to momentum and all that, we believe we would be able to get to the similar cost of acquisition what we had for past year. And on F&O volume, revenue and all that, again, it is a function of market. Once you see volatility and momentum in the market, lots of retail will come back and you will see that order, revenue per order would almost come back to normal. On cash side, because lots of people who stopped dealing in option because of ticket size increase and all that, they have come back in cash and they're doing margin trading and all.
All right. And finally, on the commodities front, your business declined 4%. It was explained by a high exposure to oil. But, now gold is doing extremely well. Are you exposed to that? And would we see an improvement in your commodities business?
See, what happens when we talk about market share of overall basket, it contains oil, gold, silver and all that. But retail tends to be more active when oil is active, and retail tends to be less active when gold is active. In gold, I think mostly uh, HNI, ultra HNI would be taking a big kind of like calls and all that. So whenever this kind of like balance changes favoring precious metal and all that, you will see some dip in our market share.
For the year, Mr. Tucker, for FY26, right? I was looking at some estimates. They are projecting a small single-digit decline in top line and a slightly larger decline, but single-digit decline as far as bottom line is concerned. Should we work with those kind of expectations? A subdued 26? What's your sort of sense?
See, FY26 this year would be a year of consolidation where we would be focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of top line we will achieve because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
Okay. All right, Mr. Tucker, we'll leave it there. Good conversation as always. We wish you all the best of luck, and we'll continue to touch base with you over the next few months and quarters as well. Thank you indeed. I think the market's up 160, holding 24,000. Time for a quick commercial break. We've got a discussion lined up on, of course, the trade negotiations, US-India bilateral trade talks in focus. You also have the US Vice President J.D. Vance arriving in India for a 3-day visit. All of that in focus on the other side. Welcome back. Markets doing well. 24,000 on the board on the Nifty futures joining us. Nifty Bank making a new all-time high. And of course, at the margin, there is everyone keeping an eye on the trade negotiations, which are due to kick off. I mean, at least to finalize the outlines of what final negotiations will look like. I mean, the topics that need to be covered in those negotiations. Well, we also have US Vice President J.D. Vance and his family in India on a 3-day visit. They're going to be in Delhi, they're going to be in Jaipur, they're going to be in Agra.
Okay.
Your mic, Prashant, I think you fix that. So we'll just keep an eye out on that. Those visuals coming in. That's the official airline of the United States of America. They seek to unlock economic opportunities, like it was said, to negotiate a bilateral trade deal. Let's see. We'll get the first visuals of J.D. Vance and Usha Vance off that plane right now. I reckon, it's when it's the vice president who travels, it's called the Air Force 2 and not the Air Force 1. So not sure the nomenclature that one has to use for that airline out there, but shortly enough we'll get the visuals.
By the way, Mangalam, I got my mic back, and kids as well. I mean, I think it's a full family visit.
But it seems like it's more of a cultural trip. Like, of course, there is going to be bilateral trade negotiations. There is a state dinner with Prime Minister Modi, but I think he wants to show.
I'm not sure, but I think this trip was planned before the election. I think because, or maybe now, of course, he travels in his capacity as vice president. But there you go, full, of course, protocol, etc. He's coming in, I think, at the Hindon Air Base, from where I think he'll travel to Delhi, and where, of course, I mean, there'll be official meetings, etc. I think there's a meeting with Prime Minister Modi later today, and then I think that's a Palam Airport, beg your pardon. And the team coming down, we should have the first pictures, first visuals coming through in just a bit from now. So we'll keep those visuals at the side of the screen, and we'll sort of talk about this and as those pictures start to come in. Well, let me welcome in Ajay Sahai, Director General and CEO at FIEO, and Anup Vadhavan, former Commerce Secretary, Government of India. Gentlemen, good morning. Great to have both of you here. Prashant this side. Mr. Vadhavan, if we can start with you, sir. This visit, of course, is coming at a crucial time. of course, I'm sure trade talks, etc., will come up, but we don't know in what capacity, how will it happen. But my question to you, Mr. Vadhavan, is that US team is in the US this week and there are going to be discussions. So how will this, in your opinion, work? There are these reciprocal tariffs which have been put on hold for 90 days. There is that, and then there is a trade deal. So when these discussions happen, you're discussing what? Because 8th of July, if nothing happens, these tariffs come into force again. So you've got to avert that. But obviously, you can't get a trade deal by then. That's only by fall. So how will this work out?
That the level of the Vice President, Mr. J.D. Vance, will be at a broad level. As far as the trade agreement is concerned, I think much ground has been covered. Looking at press reports, I think both sides have worked out the broad framework. There is some talk of a 19-chapter agreement. There is talk of a phase 1, which will be completed by September, October, I think covering the goods part, and a phase 2, which is supposed to happen after that, which I think will cover services and other issues. And within the phase 1, the goods part, there is talk of an early harvest within 90 days. So that will happen even before September, October. So I think much ground has been covered, and I think both sides seem to have developed a certain comfort about these negotiations, and I see them happening smoothly. As far as the Vice President's visit is concerned, I think that the discussion will be at a broader level and will go beyond trade. And then we must not forget his India connection. I think his India connection would have been one reason for him to be very keen to make this visit. So I think we have to see the thing in totality.
So this visit aside, as far as negotiations, you're saying that there's, from what you sense and what we read, etc., there seems to be a broad agreement on what all needs to be on the table, which needs to be up for discussion, right? Because we are at that stage here.
Right. So there is always a framework agreement you have when you start a trade negotiation. So I think that framework has been broadly worked out. All the timelines have also been worked out. And I'm sure there'll be an understanding on both sides as to what each side has by way of wants, what each side has by way of sensitivities. So I see a fairly smooth negotiation happening. And I think over the years, we are quite clear as to what are the aspirations the US side has in terms of goods market access. We are quite clear about what aspirations India has in terms of goods access and in terms of our services ambitions, especially our IT businesses, etc. So I feel very hopeful that we'll be able to.
Yeah. According to you, what would be the ask from the US side? 3 or 4 most important things.
Yeah. So clearly. Is it for me, the question?
Yes, it's for you, sir. Mr. Vadhavan, go on.
Clearly, autos, both 4-wheelers, 2-wheelers, including electric vehicles, items like ethanol, items like wines and, bourbon and other alcoholic beverages, dairy and agri products certainly will be on the request list. So I think these will be the basic asks on the US side, and our asks are also quite clear, textiles, gems and jewelry, leather products, our engineering products. Of course, pharma, they don't face very high duties, but, pharma, there would be requests for facilitation in terms of, regulatory approvals. Those take a lot of time sometimes. So I think both sides have these fairly well understood, asks.
Okay, I think those are pictures coming in. First pictures coming in, J.D. Vance and Usha Vance coming down the stairs there. And, so first visuals are coming in at this point in time. And by protocol, you've got, him being welcomed. I think that's Ms. Ashwini Vaishnav welcoming sort of Vice President J.D. Vance and visuals coming in as we speak. So that's from the Palam Air Base at this point in time. All right, Mr. Vadhavan, I'm going to come back to you in just a bit because I want to ask you whether what you said, right, from the US side, agricultural products are going to be hard to do, and also there are tariffs, but there is also market access, etc. Right? There is the issue of VAT, for example, which I don't know if that'll be contentious, etc. So just coming back to you, but let me get in Mr. Sahai into the conversation. Mr. Sahai, I was looking at this data, and I put this data out in the morning as well. This is from a firm which tracks container shipping around the world, about 65% of it. So it's a pretty good data set. And their data shows that US imports in the first week of April as compared to the last week of March, imports into the US fell 64%. Exports out of the US fell 30%. This is week on week. But this is first April data, and there would be that element of, getting shipments through before those, before that 2nd of April deadline. So they you'll have to adjust for that. But this is still very large impact in that sense. Could you give us a sense of what the situation is out of and into India? What's the feedback you have?
In fact, so far the imports into India is concerned, that's not much impacted. On the export side, since we have 90 days pause period, companies are trying, and in fact, buyers are also insisting that they should ship the goods because there is certainty on the tariff front, at least in the 90 days. Nobody knows within 90 days whether BTA will be concluded, whether there will further deferment or the reciprocal tariff will come into effect. So probably there will be some front loading, which was there earlier also. Probably that may continue, subject to availability of inventory and also the production cycle for number of products. So as of now, both the sides are trying to push within the 90 days. And at the same time, we are hoping that, as told by Mr. Vadhavan, we may have at least first tranche with reference to the tariff negotiation, and we can take other issues subsequently, because as of now, the tariff is the priority.
Mr. Sai, what you're saying is, so anything that you're agreeing to in terms of contracts, etc., exporters and otherwise, July 8th seems to be the outer limit for now, right? That's the 90-day deadline.
No, that's true, because up to 90 days, we know there will be only the MFN plus there will be a baseline tariff of 10%. Nobody knows. So it's not that the Indian exporter, even the foreign buyers, the US buyer, they're also looking from that perspective. Because if the duty goes, let us say, to 26%, they will also require more liquidity, as the duty has to be paid upfront at the time of clearance of shipment. So they have to have the excess liquidity at their disposal also. So to the extent possible, both sides are looking into whether they can push the shipment within 90 days. If it is not possible, and we will see what happens there. We are also hopeful that at least some relief to India will come, as we have the early mover advantage. We are already negotiating the BTA, and we hope that at least the first tranche will lead to tariff, or if not, the early harvest will be in place to take care of the lower duty on the Indian exports.
And in terms of sectors, Mr. Sahai, you heard Mr. Vadhavan, textiles, gems and jewelry. What specifically, according to you, should be in focus as these negotiations go through?
In fact, our focus should be on the product which we are exporting to the US, and also the number of products where shift from the market from China will happen. We did a study and we observed there are 175 tariff lines at 6 digits, where India's export to the US is roughly 50% of the total export in respect to 175 tariff line, and so is the US. So that can also be a priority area. We have to look into our existing product of exports as well as the potential product of export to get the duty relief for them.
Mr. Vadhavan, you briefly mentioned in terms of US's demand, agriculture, horticulture, etc., right? Would that be a problem?
I don't think it will be a problem. There available sensitivity. You typically have staging of duties, so the duty doesn't come down immediately to zero, or it comes down to a moderate level over a certain period of time. You have things like tariff rate quotas, where you restrict the quantity which comes in, and you have maybe a moderate duty, not a zero duty. You have things like minimum import prices, only the higher end dairy products, higher end, wines, etc. can come in, so that they serve a separate niche and they don't threaten the Indian domestic manufacturers. So I'm sure they'll find a way out. As you mentioned, the main thing will be the SPS protocols, sanitary and phytosanitary protocols for agricultural produce and dairy produce, which are very important in the interest of human health, animal health, plant health. So those are important. American dairy products have this issue of, the cows being fed with sort of animal-based feed. So that is a issue with us. It's a cultural, socio-cultural issue in India. We've been opposed to having dairy products where the animals are fed with animal feed. That sort of undermines the concept of milk, being vegetarian and dairy products being vegetarian. So we'll have to find a way around that problem. And last time we were discussing with the US, some methods were being found, to have ring-fenced production where the animals are not fed animal-based feed. So I'm sure there are mechanisms available for dealing with those problems. We are going to have to deal with them also with EU. We'll have to deal with them when we are negotiating with UK. So these mechanisms are, I think, on the table.
That's a very interesting point, which you bring up, and there'll be so many of these sort of specific things, right, which will come up across various product categories, but very interesting. We'll leave it here for now, Mr. Vadhavan and Mr. Sahai. Appreciate both of you joining us, but we'll invite you back as we get more information in terms of how these negotiations, these talks are proceeding, and continue to get more perspective as well. We'll go across now to our segment, Quarter Se Quarter Tak. We are getting you expectations from one sector every week. And today we have expectations from the NBFC space. Abhishek is standing by, and then we'll get into a discussion. Abhishek, lay it out for us.
Well, Prashant, to begin with, NBFCs could see seasonal tailwinds amid selective stress in Q4 FY25, and they are likely to see peaking of cost of funds for them. So seasonal positives to support is the growth. Q4 is seasonally a strong quarter for NBFCs with improved disbursals, recoveries, and collections as well. So tailwinds to asset quality is expected, aided by government project payouts, better winter crop yields, as well as the fact that business team incentives are there in place. So net interest margin is likely to remain comfortable as 15 to 20% of borrowings are repo linked, and they may offer a cushion despite a rise in cost of funds which are nearing the peak right now. Now stress pockets show signs of stabilization as well. Early signs of breather in stress segments such as unsecured loans and microfinance is seen right now. So management commentary will be the key gauging factor to see if the stress has peaked or not, especially in the unsecured and MFI portfolio, that is microfinance portfolio. Selective weakness will persist, like muted disbursals is expected in prime housing loans, vehicle finance loans, and unsecured or personal loans, tightened due to recent regulatory scrutiny that we are seeing. Now, housing loan disbursals is expected to be impacted by registration-related issues in the cities of Bengaluru as well as Hyderabad. Collections and recoveries will set to improve in this quarter, given the fact that seasonal pickup is always seen in Q4 with respect to collections, driven largely by the Rabi or winter crop, realization, government project payments, and target-driven efforts by sales or collection teams. So credit costs will remain high for the players in the microfinance sector in Q4 of FY25. On your watch list, large H1 FY25 slippages likely to stay sticky for the lenders, with full recovery potentially slipping into H1 FY26. Now, close monitoring of commentary on stress levels in unsecured and microfinance portfolio will be critical to watch out for. Some key estimates that we have from Kotak Securities includes Bajaj Finance reporting a YOY growth in NII by 22% and PAT up 18%. Bajaj Housing Finance NII up 34% YOY and PAT up 61% YOY. Chola Mandalam, they expect NII to grow by 30% YOY and PAT to be up 20% on a YOY basis, while for Muthoot Finance, Kotak Securities estimates NII growth of 35% YOY and PAT growth of 43% YOY. Spanna Spurti, Motilal Oswal estimates NII to decline by 13.4% YOY, while they can report a loss of nearly 414 crore versus a profit of 129 crore in the same quarter last year. Back to you.
Thank you very much for that. Digant Haria is now joining in. He's the founder at Green Edge Wealth Services. By the way, look at the Nifty Bank go. The Nifty Bank is consolidating its hold above 55,000. It's 55,200. It's a new record high for the Nifty Bank, even for ICICI Bank, HDFC Bank. And Hormus points out that in the last 25 trading sessions, from the March 11th low of 47,700, the Nifty Bank has scaled close to about 7,000 points. Digant, it's only getting stronger, especially for names like ICICI Bank and HDFC Bank. Before we get chatting about NBFCs and the expectations, first come in on the numbers that we've seen from these two large private sector financials.
Yeah, morning, Rima. See, ICICI continued its streak of very strong numbers, but if you just see, their loan growth has been a little bit tepid. Everything else is spick and span. And if you look at HDFC, you can actually see something reverse, that, the loan growth has probably not picked up, but margins have started to improve. So I think it is just telling us one thing, that probably ICICI Bank is at the best of its performance and HDFC Bank is at the worst of its performance. So, if I look at next 12 months, I think a switch trade from ICICI to HDFC will do a lot of good to investors. At least that is what we see it.
All right, let's talk about the NBFCs now. At a time when, there are private sector banks which are looking up, the rate cycle is on the lower end and consumer sentiment seems to be improving. Where would you, place your bets in the NBFC space? Do you think they're likely to outperform growth when it comes to their bank counterparts, or do you think NBFCs still have a couple of quarters before they outperform banks?
Morning, Mangalam. See, I think NBFCs also, you can see a very similar pattern. Let's see, all the top quality NBFCs have already made lifetime highs, and they're pricing in a lot of good things which will come in the next 12 months. So something like a Shriram, Chola, Sundaram, Bajaj Finance. I think a lot of up moves have already been made. It's not very easy to see big up moves because the earnings are not going to surprise in a materially big way, because in the previous show also I said the PSU banks are alive and active and the competition will be very high. What we are seeing is some bit of easing of the last 12 months. So I would think that in the NBFC space you should play the other segments, not the very high quality segment, because there a lot of the upsides have been captured. And I was just watching QSQT, what Abhishek was saying. So this quarter we should do something different, in the sense the segments which will give very good results are probably the segments which are going to peak out. They will not give great returns or great upside in earnings. So vehicle finance is one where we think we have peaked out in terms of the cycle, and gold finance also, because of the regulatory guideline. Both these sectors will report very good numbers, but that very good numbers should not be treated as what will come in the next 12 months. Next 12 months can be a little softer. Whereas, in sectors like, say, microfinance or personal loans and personal finance, I think the stress will bottom out either in this quarter or the next quarter. So we will actually be very watchful in places where results are bad, because if the commentaries are good, we know that we are probably at the end of the stress cycle.
Any particular picks in the microfinance which are close to bottoming out or may bottom out in Q4?
So I think there is a huge buffet available. Banks like AU Small Finance Bank or Equitas and an Ujjivan in the bank, small finance bank space. Then in the NBFCs, you have something like an Arman and Credit Access. So it's a huge basket which is available. Even maybe L&D Finance is microfinance heavy. So 5-6 names, I think, that should do well over 12-18 months. That's our take.
All right. Digant, thank you so much for joining us and giving us your view on the way the sector is likely to be. The good quality stocks have already hit a record high. Speaking about record highs, a big move is what we're seeing in the Nifty Bank, which we've been pointing out earlier itself. But today's up move is supported not only by the Nifty Bank, but a firm recovery in the IT pack as well. So we have, Tech Mahindra, which is doing well among the top Nifty gainers today. We have Infosys, which has recovered a fair bit from the lows, currently at the high point of trade once again, opened higher, thereafter saw a sell-off. That sell-off had been bought into. Right now, we're back around the higher end of today's trading range so far.
Even Tata LXC, it opened down 2 to 3%, and now it's up 5%. And here the numbers for sure were very disappointing, right?
I take that point. So that's about the IT pack and the Nifty Bank. And as we speak, in fact, 24,050. That's an important mark, because the 24,050 mark is the 200-day moving average on the Nifty. The Nifty is around the 200-day moving average. Good time to get in the technical picks then. Mitesh, 24,050 was our first target on the Nifty, with the next one being around 24,200. Do you think now that we're close to 24,50, there is a trade that may take you another 150 points higher?
Mangalam, I think that's the tricky part of the entire thing. You met one target, it's an important level. You've hit the 200 average after a big decline. My idea is that I think, if you're not taking profits, I would still suggest take 30% or 25% off the table. Or even if you're not inclined to take profit because the trend is still strong, at least trade your stop losses to very tight levels. So on the Nifty, I would say now I think a good trading stop will be around 23,974, 970 or thereabouts, and 5 points below than that. And yes, I think eventually we will hit 24,200 and possibly even make an attempt towards 24,758. Those targets are still open, but to know if the consolidation will start right now or some profit will happen right now is very difficult to say. So I think that's the way trading should be approached. The buyer should remain on the downside, and only you might want to lighten up 1/4 or maybe 30% of your positions.
All right, and your trade at 10 would be?
Yeah. I have a buy on gas authority with a stop at about 192.5 for targets of 204. And Kotak Bank is another one which I like. That's a buy with a stop below levels of 21.70 for targets of 22.65.
By the way, it'll be interesting to see the FII numbers, right? I mean, it looks like they are piling in big time. I think last week FIIs bought stock worth about 15,000 crores. And of course, I mean, multiples of that went out over the last 7-8 months. So it's a bit of a, I mean, the way the market is going looks like they're stomping right back in. And of course, I mean, the other thing is this U.S. vice presidential visit. Apart from, there's a fair bit of symbolism with things like this as well, because, you've got practically a bit of a trade war, a very, very antagonistic attitude with the U.S. under the Trump administration to everything else, to all other countries. And in that scenario, the second top person in the U.S. coming for a visit to India, I think a fair bit of symbolism in that sense, for sure. 200 on the Nifty, 24,050. We'll take a quick break here. Manisha will be joining in with commodities in focus, and I'm sure gold will make a mention there. Stay tuned.
Welcome back. Let's turn our attention now to the commodity markets. Manisha is joining us in the studio. Manisha, gold prices, have they hit 1 lakh? If you go to buy now, go to the store?
Oh, well, absolutely, yes, Reema, and I'm going to exactly show you that calculation. Well, let me start with the international prices first, and we are trading at an all-time highs above $33.85 an ounce. I mean, this is an all-time high, and this is the 15th time that you have seen an all-time high above $3,000 an ounce. And my next plate shows you exactly that, the calculation for the Indian markets. So we have seen the gold prices open at an all-time high of 96,745 rupees per 10 grams. Now, this is the price for 24 carats. This is a price which doesn't have anything added to that. But I'm going to add 3% GST to that, because if you go out and buy gold in any form, 3% GST is basic. So with that, it's at 99,650. And if you're buying gold, you will have to give a minimal making charge, even if you're buying a coin or a bar and jewelry especially. So I've taken a minimal 10%. It's much higher at this point in time, but 10% of a making charge on that. And the gold prices are at 1,09,000 rupees per 10 grams. I mean, yes, it is 1 lakh now in the physical markets, and this is a basic price. If you're buying jewelry, anything more than that, you're going to be paying much higher than that. For the Indian markets, for most of the Asian markets, by the way, there are reports that the physical or jewelry buying clearly has been on a decline. I have been speaking to some jewelers, and they tell us that 30 to 40% of a decline in jewelry buying is what they have faced in last couple of months. And the exchange jewelry or the scrap jewelry really seems to be coming into the market. So people are, one, making profits, and second, they are selling their old gold, buying newer gold, or just selling gold because the prices are so lucrative at lakh rupees a 10 grams there. Now, the reasons why you have the gold prices running higher, one is, of course, the dollar index, which is trading at a 3-year lows below 99 now, has been one major absolute recipe for the gold prices to continue to go higher. And then Trump ordering investigation on critical mineral imports has added more uncertainty, and thus that premium. The third thing is about the European Union, where we saw an interest rate cut coming in on Thursday, and that is higher gold yielding. So we have seen gold buying reports coming in from the European Union. And then Trump's statement on firing the US Fed Powell has just added yet another more fuel to this premium that we've seen seen come in for the gold prices. I want to take you through a report card to show you on what gold prices have done. So on a weekly basis, we are up by 5%, 12% up in last month. And in this year, now we have surpassed on what kind of gains that we saw in previous year. So last year, the gains were 28%. We are up 29% in 2025 already. And the last 12 months have given you 45% returns in case of gold prices there. And the view from here on does look that the momentum will continue higher. Deutsche Bank, Goldman Sachs have talked about $3,700 an ounce and much higher levels if that level also gets broken. Bank of America, well, that level of $3,350 has been taken now, and Citi's talked about $3,500 by the end of May. $35 to $3,700 an ounce is a view that has come in from UBS, De Beers, Swiss Capital, SD Bullion. I was talking to them last week and they said $3,500 by the month of May, and then for the month of June, July, August, in that quarter, perhaps some profit taking could come. But next couple of months, with the kind of uncertainty, you're not going to short gold.
Well, I think we had Ed Yardini this morning talking about 4,000 by the end of the year. Possibly. I mean, it was not a forecast, but he said, well, it's possible. Thank you very much for joining us. So gold very much at the center of things in terms of what's doing very well. The market here is doing phenomenally well as well, about 1% higher on the benchmark indices, Nifty Bank at a new high. We'll take a break on the other side. It's our special segment. It's the economy. Lata in conversation with Santanu Chakrabarti of BNP Paribas, and they discuss the quarter gone by for big banks like ICICI and HDFC Bank.